right, get ready for the second study in Wyckoff. Some of these studies, they don't seem very eventful or nothing special. You have to read between the lines. All right. So the thing is that these are his original studies. This is Wyckoff studies written by him. All right. So, and he basically is using for day trading, he's using the wave chart, and he's using this, which is called a tape reading chart, but I think now it's called a footprint chart. And it's when he did it, he did it on a point and figure. All right, it's called a footprint chart now, but what you'll see if you look online is the footprint chart is typically done on a candle. Some folks will do it on a PNF and a range bar chart. But from what I'm seeing, this is like the earliest evidence of a footprint chart. There's no other that I know of. So this was done in 1930s by hand. The idea is really still the same. You can't really get away from buy low, sell high with high volume at the bottom and high volume at the top. No matter, how old the charts are, it's the same idea. And so anyway, basically just a footprint with numbers or a point figure with a volume. And this exists today as well. It's just that you cannot have it on a tick by tick basis. So you just have it on a consolidated. Instead of tick by tick, put a point by point. Right? Or more. 1 point, 2 point, so on and so forth. Alright, so let's start. I'm going to start this. And on the left hand side, oh shit. Anyway, I don't know what happened to that ruler, but on the left hand side you have the study. On the right hand side you have the chart. I went through some of this so I can go through the study pretty quickly. And let's go through it. Alright, so stock has come down from 51, and at 2 p.m. June 1st it stands at 48. I think this is the one. I think it's this study. Alright, anyway. This chart begins at 86 and a quarter. And where's 86? 86 and quarter is just 2/8. So in those days they had in eighths. Each square box is an eighth. So the chart begins at 2/8 or 1/4, which is right there, the 10, right? On an upward swing from 81 on June 9th, the wave chart at the opening gave an upswing. The active trader does nothing until the clearly defined line of support under the light pressure at 86 and 5/8. 86, 1, 2, 3, 4, 5. So he's looking at a line of support. You don't do anything until support or resistance, if you're going to go short, develops. How does it develop? It needs to create a line of support, a line of resistance. This is one of the key points. And when you're using this kind of chart, right, it's not like a candle chart, or the point and figure specializes in like lines of support and resistance, because counts are done off of those lines. So I want to harp on this, that the active trader does nothing until clearly defined lines of support under the light pressure tells him to go long with a stop a quarter or half below the bottom of the dip to 86 and 5/8. So this is 86, 1, 2, 3, 4, 5. So he does nothing until a line of support develops and it has a low volume pullback, what he's referring to as light pressure. So let's just add that. You can see the light pressure is like 3 and 1 and all that right there. So just put light pressure. And now over here too, like the 1 and the 1, that is definitely light pressure. See that? The 1 and the 1 right there. All right, so basically, where am I? The actuator does nothing until the clearly defined line of support under the light pressure at 5/8 and 3/4. So this would be 1, 2, 3, 4, 5/8, and 3/4 would be 1 level higher. All right, which is basically 6/8. Tells him to go long with a stop. So here the point is that light pressure equals go long. Okay. So from the prior study and this study, what do you see as is a difference in going long? The difference is, in the prior study, he waited for the higher high because it was a deep pullback. After that pullback, it was an accumulation base, and then had a climax and all of that, and change of behavior, and then broke the high, and he just took the high. So this study is different in that he is looking at the lines of support to go long instead of the higher high. Here he has a signal long. See that? So first the long, and he's looking at the line of support, and then he goes long, but I'm not sure where exactly he goes long. All right, so let's see. Under the light pressure at 86.58 and 3/4 tells him to go long with a stop. Okay, if he places his order when the stock is at or close to its low, he would probably pay 87 for it. And his stop should be 86 3/8. So it would be 1, 2, 3. All right, so he's saying he's going to pay 87 for it on the reversal up here. So long 87. Okay, stop is going to be 86 3/8. So stop is 2 boxes below line of support. I'm going to mess this up. Something like that. So that would be where it says S. See that? S. It's 2 boxes below. So this is important because now you have how he took the action. He waits for the base, then the market goes up. This is where he goes long at 87, and his stop is 2 below the support line. All right. By the way, why do you want to always put it below the support, not right at support? Because support can get tested and support can have can be penetrated with a spring. So if you see the S&P, it happens all the time. So anyway, okay, if he places his order when the stock is at or close to its low, he would probably pay 87 for it. Now that's not the case today. So, you know, I know that if he places his order here, if you place your order here, you're going to get filled at support. That was a different time. He didn't, you know, he had to pay a little bit more. All right. Right. So anyway, he's buying support. That's all it is. Light pressure equals go long. Put in the order, stop is, all right. Now where's the light pressure? I think it's right here. With the 1 and the 1, that really is light. Well, this is light pressure 2-1 and 1-1. 1-1 for sure is the lowest. I mean, you cannot get a print lower than that other than 0. So we're going to put light pressure here. All right. Right there, the 1-1 light pressure. I'm going to put it in, should have put it in green. All right. Okay. All right. I think we learned from this little paragraph here how he's buying and how important the lines of support are. And also, like, that's where you're supposed to buy it. Even if it broke out, you want to get it near the lines of support. All right. Stock works out of this range on the upside and on a reaction to 87.5. What's that? 87. 1, 2, 3, 4. Let's just put this here. 87. All right. 1, 2, 3, 4. All right, right there. See, 87.5. So breakout here. Put the breakout. Okay, so that's the breakout. And okay, so stock works out of this range on the upside and on the reaction to 87.5 meets support amounting to 2,500 shares. So I can't really read it. I think this is it. I'm not really sure. But the idea is this 2,500, okay, at 87.5. I'm not sure if it's one print or he's taking the entire line, like 1, 2, 13, 14, 15, 16. And this is too messed up for me to figure out what that is. On further 1/2 point bulge to 88. That's the 88 right there. The trader observes the increase in supply. All right, so there's the supply. All right, increase in supply of 1,400 shares, then 300, then 1,700. You see here this line, I know it's hard to see, but this line here is 14. This box has a volume print of 14. Then it has 300, and then at the top it has 1,700. So why is that some supply coming in? How do you know? Okay, you gotta use just common sense and see if the biggest print is at the bottom of a column, it's demand. If the biggest or the highest volume print is at the top of a column, it's supply. Again, if you have a column of P&F with all these prints, if you have a big print at the bottom, it's demand pushing the column up, pushing prices up. But if the print is at the top, then is it demand? Is the CM going to buy that? Or are people buying breakouts, and if they miss the breakout, they're just hitting market orders and buying it higher because of FOMO? So obviously, someone's selling at those prices to them, and it must be supply. It's just where the print is located. If it's bottom, it's demand. If the top is supply. That's straightforward. Oh, God. All right. The gain over the previous top is only 1/4 point, and the reaction to 87.58 is 3/8 with 1,000 shares. So he's looking at the high to high, and you all know this. For Wyckoff students, you should know this. It's just high to high. If it's a very little distance, what's happening to the thrust? It is shortening. So you have high to high, is a shortening of the thrust. You want to see another shortening of thrust, like rail trading? I was going to take this, but day ended. So this is the S&P, right? So now it went down and it did this. Okay? Now look at this low. Look at this low. What do you notice? The low to low has shortened, right? And you see how the print, that big print, is at the bottom? What do you think that is? As I explained, if it's at the bottom, it's different than it's at the top, right? So here, it's demand. That right there is demand. And now I wouldn't be surprised if it gaps up. If it was definitely continuing throughout the day, this would, and it broke this high, this demand, more demand would, if it broke that high, it would start trending. All right? Because this is the stopping action. Do you know that this bar, column, has the biggest volume in 100 bars? With a shortening of the thrust, because demand right there has entered. What else is telling you to demand? This is the level. So remember, you want to look around levels, not just, just in the middle of the range, right? This is the level. So you want to call it spring, a shortening of thrust, it doesn't matter. This right here is demand. It hit the level and boom, look at how much volume was coming in. I had this in advance here, the line, in advance of all of this and waiting for it, but it took all damn day to, to go and then market closed. But this right there is the idea, right? Shortening of the thrust, demand at the bottom, because it's at a level and it's not going through, it's reacting. So, I mean, what do you think is happening? Same as here, this some heavy supply. So, I mean, the point here, I don't want to get into this, is that shortening of the thrust, where was I? 1 second. So the gain over the previous top. All right, so you have shortening of the thrust with 1,000 shares at 87 and 5/8 at the bottom of the dip. 87 and 5/8 is right there. 1,000. 1,000. Bottom, if it's not breaking, it's demand entering. I'm not sure why he's not saying that, but let me see if he says it later. There is a rally of 3/8 to 88. So after the 1,000, you have a rally up. That 1,000, he should have said demand. Like right here, the 17 is supply, which makes the market pull back. It goes near support at 87 and 6/8, where 1,000 shares comes in and gets bought, and then it goes up, rallies up because the demand. It's at the bottom of that column. It's going to go up, right? If especially has no follow through, and even if you don't know, just wait for the rally and then buy, try to get in the pullback. The gain over the previous top. Okay, and did that already. All right, at the bottom of the dip, demand. Demand, demand, demand. Put D and D. That's demand. The supply up here, demand there. Okay. All right. There is a rally of 3/8 to 88, another quarter dip. So there's a rally of, and this is the dip. And what else? Which has a higher support. Then a snap up to 88.5 on light volume. Why is it light? It's light because there's not a lot of, these are all ones in here. I know you can't see it because of the red markings, but this is another key behavior, okay? The behavior here is important because it is a low volume rally at the top with the highest print at the top. Meaning it's a low volume rally at the top of a trend so far, with its highest print at the top of the rally. Highest print there relative to the column, the rally column, the up column, the highest print is supply because it's at the top. But taking a look at the entire column, you see that its volume is decreasing, which is what? It means that the rallies are losing steam. They're losing demand pressure. All right, so you have light volume with 500 shares traded at the top and an immediate recession of 5/8 point. Where's the 5/8 point? Right there. Now, there's another important thing. The trading zone is confined from 87 and 7/8 to 88.5. What is he saying? 87 and 7/8 is just the bottom and the top of the rally or the column. That's all he's saying. The bottom and the top of the up column is defining the trading range. On the last dip, 1,100 shares were traded at 88.25. I don't know where he's talking about. I don't know. Oh, okay. So 1,100 is right here. At the, you see the circle? That right there, supply. Okay, now one of the things that you want to do is identify if that 1,100 is meaningful or not. I think that 1,100, one print of that 1,100 is bigger volume than the entire rally. Again, that one print has more volume than the entire up column. That, he's not, I don't know why he's not calling it out, but that's your change of behavior. That's why I don't know why he doesn't do that. Like, he doesn't call out. He just says, it's 1,100 shares. But the interpretation of that is your change of character or your change of behavior. That's why these studies are a little bit challenging. All right. So that is on the last dip, 1,100 shares were traded there. And then there appears to be no demand at 88 or 88 1/8. This indicates weakness. So two things indicate weakness. One is the change of behavior, and then the zero prints. There's zero prints. First is the 11 that came after the lack of demand rally. Right, because that print has more volume than the entire column. That is a big print down. So that's your change of behavior, bearish change of behavior. Underneath that, you have 0, 0, which is as the market is going down, there's nothing there. There's nothing to support the market. All right, all that together, meaning the low volume rally plus the big print reversal, plus the lack of demand underneath that print is all painting a picture of weakness. The trader now pushes his stop up to 87 5/8 because he's suspicious of the long side. Again, what gets him suspicious? 1, low volume rally. 2, change of behavior. 3, low volume on the pullback demand, meaning as it's going down, there's no demand. All right. So at lower prices, no demand. So he's getting suspicious. And he decides to sell on the next bulge. Now understand this. He has a change of behavior. The next bulge is like a pullback. All right. I don't recommend, I don't think it's a good idea to just sell at the next bulge. It's better to look for a pullback. not to short the highs, but he's ready to do it based on all of those evidences together, right? Also, that next bulge, some traders will do it. I don't think it takes out the high. Let me see. It's because this is the high. The high is here, so 88, 1, 2, 3, 4, 88 and a half. So it goes to 88 and 4, excuse me, 88 and 3/8, not 4/8. So that's just less than the high. It's a test of the high, right? But it's not, doesn't go all the way to the high. Okay, the next bulge is to 88 and 1/4. Oh, so he's going, so he doesn't show that he shorts here on this weakness here. Or here, I guess. Close out and sell short. Where is he closing short? Next bulge is 88 and 1/4. So that's 88 and 2/8. That's right there. The tape reader now raises stop to 87 and 7/8 under the last low, All right. So typically, if you see the way he's moving the stops, they're typically two boxes below the line of support. See, 1, 2, 1, 2, 1. This is only 1. Now he's bringing it close. But typically, if there was no indication, he keeps it about 2 boxes above or below. If there's an indication of a change or a turn, then he brings the stop right under the low instead of 2 boxes below the low. And then there's another bulge in light volume to 88 and 3/8. This so 88 and 3/8. That's right there. This is the bulge, another bulge, right? He raises his stop. This stop order should double his holdings so that he sells twice as much as he is long. Okay, so now we understand how how he goes short, or how he exits his long and goes short. All right. So the way he does it is it breaks the low. Okay, it breaks that low. All right, so here's the point. He's moving his stops. He's moving his stops. He's moving his stops. Okay. Then it goes up here. As it breaks that low, means it took out the low, which makes sense because that's one way he likes to see higher high confirmation and lower low confirmation, right? And here he wanted to buy support. Well, his thing is over here that he wants to exit his long position and take the short position. So here he has all the evidence, meaning change of behavior, and he wants to go short. So now it pulls back, and he sees the weakness, pulls his stop, then it goes up, and as it's breaking the low, he gets out of his long and establishes the short position. That's what he is trying to do. This gives the active trader a short position at 88 and 1/8. He immediately places up a half-point stop on his short, which makes the stop 88 and 5/8. Again, where is it? See? 2 boxes above. 2 boxes above. The profit on the long side was 5/8 of a point. Okay. Was 5/8 of a point. I don't know about that. If you went long here, it should be much more than that. All right, the profit on the long was 5/8 of a point, 1 1/8 point less profit for overhead. All right, now the volume is very light, and at least a technical reaction is indicated. There's a dip to 87.5. That's the dip, followed by another to 87. So that's the second dip. Dip, dip. The rallies are fractional at first, then there is a 3/4 rally from 87. 3/4 is 6 boxes. 1, 2, 3, 4, 5. And I guess over here it would be 6, 5, so about here. And alright, followed by another to 87. So there's a dip to 87.5, followed by another to 87. So from here, you have a dip to 87.5, which is this and this. That must be somewhere around here. Somewhere around here. There's a dip. Alright, the rallies are fractional at first. Then there's a 3/4 rally from 87 with volume. 3/4 rally from 87 with volume. Volume decreasing at the top. All right. There's a 3/4 rally, 6 points, 6 boxes from 87. I'm not sure where it is. Is it this? The rallies are fractional at first, and then there is a 3/4 rally from 87 with volume decreasing at the top. A 5/8 dip and a 1/4 rally leave the stock at 87 3/8 with 800 shares on the close. There's a close. I guess he's talking about all of this. Close right there. Anyway, the point here is that it's over here as it goes up, it totally declines in volume. That's all it is. And we'll talk about dips in that, but the real point is right here. The volume is now very light, and at least a technical whatever is indicated. There's a dip to 87.5. So that would be somewhere 1, 2, 3, 4 right here, followed by another to 87. That would be there, I think. And then with volume decreasing at the top. So volume decreasing at the top means there's no demand. That this must be it. Okay. So the opening of the next day on June 16th. Ooh, where is this? Is it here or here? Is at 87.5. 1, 2, 3, 4. He's talking about this open right there. and the stock immediately resumes its decline. So that's this. The very light volume makes the traders cautious of a rally, so he instructs his broker to cover the short. All he's saying is that it's a light volume rally. I mean, not it's a light volume rally, but that a rally is coming because this was on light volume dip, low volume decline. Right there, the 2, the 1, the 3, the 1, 1s and 2s. And then finally you have a 4. Notice the 4 is the biggest print and it's at the bottom. So like I said, it's like you have to see where the print is located. At 86 and a quarter. All right, at 86 and a quarter, a rally of 3/8 follows. Okay, so I don't really see 86 and a quarter. Let's see, 86 is here. 1, 2. That's 86 and a quarter. Six and a quarter. I think that's 86 and a quarter. So I think it's talking about that. A rally of 3/8 follows. So 1, 2, 3, 4, 5, 6. That's the rally up here. That later extends to 3/4 and catches the stop. The gross profit on this position is 1 1/4 point. All right, whatever. All but 1/8 of this rally is lost soon, so it all goes right back down. But higher supports appears at first 1/8 above the previous low. So that one higher support right there. Then 3/8. Volume is light. It looks like a further rally. The trader does not go long because indications are bearish. What is the indication that's bearish? It's the volume, the light volume. Yes. All right. He merely wishes to observe the rallies and perhaps get a new higher selling point. The tape reader wants to see how the stock acts on the next bulge, whether it has the power to go through well above 88. Okay, so he just wants to see if it breaks out. Okay, or whether on the test it's going to fail. Why? Because the rally here is a weak. The volume of the rallies here are weak. So you know what's going to happen, right? He wants to see if it's going to break out above the high or not. Volume increased slightly on this further bulge. 600 shares at 88. Talking about right here. $600 right there. 400 at 88.18, 200 and 700. But it's now 2 p.m. with the trading slowing down. It seems unlikely. Because at the end of the day, it seems unlikely that there will be enough activity to give the trader a good swing in the next hour. This is just like lunchtime or the end of the day. Therefore, he's done for the day. All right, and pushes his stop. Okay. Anyway, the gist of the move is really up here on the up rally. All right, he's not really talking too much about this. He's not really being very explanatory here, but the idea is on this here, on this up move, and then taking the short. All right, and then noticing, okay, it's going down, has weak rallies, breaks, has weak rallies, finally goes down, and low volume, which tells him to cover. All right, so let's focus it on a point by point. The first point here is that how he goes long is that it creates a line of support. So basically it's like a base, or a line of support. It's basically a base, and he's ready to buy the base, especially when the volume is low. Light pressure is giving him an indication to go long, and that's what he does. He's in a base, and he notices that the light pressure it's similar to the concept of a low volume pullback, and he puts a stop 2 boxes below, two boxes below. Then it goes up, breaking out, and then finally as a shortening of the thrust. He just says the high to high, the distance is shortening, right? And then finally there's a pullback on demand. So the key points here are the line of support, the low volume in the line of support being very important. And if you want to see how important it is, here's one example today. What happened was you had this rally, right, on crude. Look at the volume, 846 or 41, it's 4600, 4100, and it's in white. It basically broke out, so that's the heavy buyers. Then it tested. Now you have a base building right here. What do you notice about the volumes? From 21, 22, all of a sudden they start dipping to 7 and 6. That right there is a low volume base or line of support. Yes, they increase 15 and 19 because they want to press down in order to go up. But if you look right before that, you will see the trend of the volume is decreasing. It goes from 21 and 22 is about the same. Then it goes to 1/3 the amount, 7 and 6, and that's why I have the low volume tester. I'm looking for that because I know it's gonna do that, because that's why you have this breakout here, right? Even here when it pulls back, right? What do you notice? These numbers are, high, 26, 22. So you use them as a point of reference. Okay, I'll use 46 and 41 as a point of reference, but the pullback is going from 21 to 7 and 6. All right, so here you have 22, 26 and 22. Here you have 3. But let's take a look at the red. Comes down 22 all the way down to 11. Okay, what about the next one? 1/3, 7. What happened? It's less than 1/3 of that volume. Here, 46 on that same line of 46s, it gets to 7 and 6. Here, on that same line of 21, it gets to only 7. 7, and yeah, you have 11, then 7. And you know what? After it went down to 7, that's probably why these guys came in. The 47 to break out. Because the volume just diminished by so much. It totally diminished. Okay? If you want to use bar volume, you will see that it's 6 and 2, which is what? 8. Here, 7 and 7 is 14. So the volume has significantly diminished, leading to the buying demand coming in. Remember, in basis, you're looking for lines of support and you want to analyze them to see if their volume is diminishing. Sometimes they have effort. Sometimes here you have, low volume, then the spring, and then the break. Over here you have, what is this? The low volume, and then this is your low volume test. That's what I'm trying to say. Here's your low volume test, and this is your low volume test. So That's what Wyckoff is talking about, but he just doesn't go into detail saying that this is a low volume test. He just says, you know, only 100 traded, or something like that. Or sometimes he says volume is light, or the pressure is light. All right, anyway, so I've gone over the base, right? So there's your base of 1 and 1 right here. What's the total? 2. So it's low volume. What's going to happen? Buyers are going to step in. No doubt about it. Over here, the next point is here. The thrust is shortening. Always keep that in mind. Here at the base, you had 10. But you have to understand what the 10 is. The 10 is not a low volume test. The 10 is buying coming in. Demand coming in. Demand coming in is different than a low volume test, because after a low volume test, demand comes in. In this case, demand just came in without a low volume test. Although the next column is very low volume. This one, the 6 and the 1. Anyway, then the next important point is what he brings up is the rally, or the column, the next column rally, whatever, the next high column, saying that it is low volume. So it's like looking at, if you see wave volume and you're comparing the rallies, typically what happens is, in wave volume, when you have a reversal, as the market goes higher and higher, you'll see the rally volume decrease, and then either it's going to turn or have a shortening of thrust, or there's going to be climactic action to turn. So it's the same idea. This is your low volume rally. And then after that, you have the concept of the change of behavior. He doesn't call it change of behavior, he just says 1100, but you can tell that 1100 is a big red print, relatively speaking. And then underneath that, you have no demand. All right. And then finally, you have a light volume pullback up here. And then one final bulge here. And then the break of that is where he takes the short. So one of the things that I see that it wasn't explained is that this is creating a base up here. There's a line over here. Okay? And that this break here, you know, you could consider taking the short after this break. Meaning you see the range, you see the change of behavior, you see the pullback, you see the break. You don't have to short the break. You can wait for the break and then sell on the pullback here. Just the alternative is to sell the pullback instead of the break here. Instead of this 3, where it's taking around the 3, you could wait until it breaks these lows, breaks the base, breaks the low, the range here, and then take the, and see it, that it broke. Now on the pullback, you short it up here. Because now there's a base, you have, you know, change of behavior, you have climactic action, not really, not that much climactic, but the change of behavior is there. And you have a break of all of these lows. So that's where to take a short. After that, it just goes down, 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 down until what? The same thing. You have a low volume rally down. Just like you had a low volume rally up here telling you there's a problem on the long side, you have a low volume rally down. But I would also say that the bottom of that rally has the biggest print. So that must be demand entering right there. Because 1, 2, 3, 4, 5, 6, look how big this column is. It's a pretty big column. And you have the biggest print at the bottom. Why? Someone's buying, you know, someone's stepping in. All right, so those are the key points. And that's all. All right. If you want to follow along, you can just, I would recommend, because this is very, a little bit difficult. You want to do exactly what I just did here, meaning you want to get on the left-hand side, have your, have the, course material. On the right-hand side, just open up Paint or something, and start marking up the chart, because it's very, very hard to read and understand what he's talking about on the chart if you're flipping back and forth. What you need to do is have it side by side and start annotating the chart, and then it'll start making sense. Take care, bye.